Hello and welcome all the viewers here again today on another video by reitspro.com. I'm Gaurav Jain and I'm an author of these two books here, as I've previously also explained in other videos, and you can always visit our site reitspro.com for more insights on REITs and invit especially, and you can mail us at this ID as well. You can buy these books online from various platforms and get more in-depth knowledge about these two subjects. Now we come here today for a Embassy REIT earnings call Q4. So as we all must be aware, there has been no estimate or DPU guidance. We'll explore that. We'll get a little more into what has happened in the earnings call, and that's because a lot of REIT investors, there is a lot which depends on the yields that you're getting, right? So there is a small disclaimer here. These are personal views and understanding as inferred from the earnings call recordings. So do your own research please to avoid any errors in my interpretation or analysis. And just to explain, the 21.71 rupees was the distribution over the year 2022-23, and this is in line with their guidance, and this is a snapshot of this. Now what is the yield right now? As we say, yield is 21.71 divided by 320. Let's say the price is 320 or 325 or whatever, and this is the yield today. So however, the pre-tax efficiency is about 9%, as I've explained in other videos earlier, not accounting for capital gains. Now apart from that, the past trends as far as the DPU guidance has been that they've always, Embassy REIT has always given a guidance. For example, in Q4 21-22, a comparable period as of now, the last con call that one had, the same thing happened last year, and they gave a midpoint of 21.7, and there has been none for FY 2024. Now, so the reasons are that they have cited is that there is a lot of uncertainty in the macro environment, and that's a global phenomena, and the micro markets are also a little uncertain in terms of the government policy like the SEZ. But however, they did talk about certain ballparks, or something like a direction based on three main factors as we understood here. So the first factor was the vacancy, the second escalation in rentals, and third was the interest rate impact. So based on the three basic things like vacancy, how many tenants are there and what is the occupancy rate, second, would there be an increment in rent, and what is the interest rate impact. So you could extrapolate what has happened in the past and then go on to the future. So that's been the idea here. So now, since the basic asset underlying a REIT is the assets, the commercial real estate assets, let's first have a look at what is the asset base as an overall picture in their latest presentation. So if you see, they have a 45 million square feet portfolio distributed over these areas as shown here. You can find more of this in their presentation. So 3-4 things one can infer from here. One is that the assets are about 45 million square feet. The value is about 50,000 crore rupees, and that translates into an average price of 11,000 per square feet. That's just for remembrance. It has not too much to do with what we're going to discuss, but just as an overall picture here. So if you look at the assets, the vacancy part, that's where this square footage is relevant. So 45 million square feet is their asset base. They are looking at a vacancy between 4 to 5 lakh square feet, and this vacancy is largely due to the SEZ policy of the government. Now what is that? The problem is that the SEZ policy, there has been demand for non-SEZ lessors. So SEZ has certain rules where occupiers are a little hesitant in taking the things on rent because there are certain rules which have to be complied with. Now this naturally requires the REIT denotifies, gets some denotification of existing areas, and those rules are somehow unclear. So they are waiting for the Desh bill or some other a simpler process of getting things denotified. So that's the first part, why there has been no clarity on how vacancy can get filled. The positive expectations here is that in the same con call it was also stated that there has been a recent denotification of 9 lakh square feet of some complexes that they had. The second part was that the expected modifications in the bills and the policies should take about 1 to 2 quarters, but say the expectation is 2 to 3 quarters. So that's not a very long period as far as real estate investment is concerned. And the third thing is that they talked about the GCC demand, where this would propel the the lessee demand and make the vacancies go down. The second part is the escalation of rents. Now we look at the escalations. So there are obviously the escalations are constrained by a certain macroeconomic uncertainty. And then the second question is that what is the cost controls that the IT companies right now in face of this uncertainty are exerting. So a lot of them are looking at cutting costs to take care of the uncertain future. So that's one aspect, and the other aspect is that there is a positive expectation in terms of that 14%. It was up, the lease was 14% up for about 8.2 million square feet, and Embassy REIT expects the same escalation for 6.7 million square feet, which would come up again for renewals at a higher rate. And secondly, the expected demand for GCCs would help them pay higher rents, because the quality of tenants would move up the value chain and they would get higher paying renters. So that's one other aspect of escalations. Now the third aspect is interest rate impact. Now if you look at it, you will have to ascertain this from the point of view of the capital structure of the REIT currently. What is the debt component therein, and what is the background of the asset values? I mean, what are the asset values? This has to be seen in the background of asset values. Therefore, in fact, asset debt financing is actually useful for REITs. It's a means for giving accretive value for the existing shareholders. But there is a caution. So the caution is that efficient financing of existing debt or its rollover is very important. Otherwise, what happens is the REIT is impacted by exorbitant costs and there could be pressure on sale of assets. That's a very problematic thing, these two things. So there, as you would have seen recently, there was a by rate, Brookfield India REIT, there was a downgrade of rating from AAA plus to AAA minus. So that these kind of things kind of impact a REIT. Having said that, the total asset and value liability position is here as far as Embassy REIT is concerned. So let me just remind you on this chart that we are looking at all these to extrapolate the earnings of the last year to the future. That's why we are doing this analysis, because there's been no DPU guidance provided. So if you look at the gross value, it's about 50,000 crores, because this is in millions, and 28% of it is financed by debt. So and the average cost is given at 7.2%, where the fixed rate of debt is 61%. Sort of 100 rupees, 61 rupees is fixed rate debt. Now, in the same conference earning call, it was also stated that 4,100 crore rupees, crores should be mentioned here, of course. NCDs are up for renewal, up from the existing 6.6%. So obviously, with a 2.5% increase in the market rates, this would go up. And then the floating rate is about 7.98%. Again, this would come up for revision in another 5 months. So there are, of course, the flip side of it is this is the this is the problematic side, and this positive side is that only 28% of the asset is financed. So the 72% of the balance, which is where the rents would increase in line with inflation and other costs, that would not be offset by a higher debt cost. So this aspect I've explained in several videos for earlier also. The second part is that do we think that the interest rate has peaked? A lot of people say that maybe it has. And then also compare with what was the interest rate at the time of IPO. Our human memory is very short. We tend to forget that at the time of the IPO, they were borrowing at an average cost of about 9.25%. And that's when the issue got oversubscribed also. So there is, okay, before I go on further, there's a WhatsApp discussion group and the link is given in the video below, description below, and you can please subscribe to our channel and be connected with regular updates with us also. So what is the summary here? So let's look at extrapolating the REIT DPU further, the embassy REIT DPU further. So the market has a lot of questions about why two CEOs have changed in the recent past. Is the best over? So firstly, that has no impact on DPU. That's, of course, that's a long-term thing, how the CEOs would perform. But as of now, it has no impact on the DPU. Secondly, volatility, uncertainty in government regulation. The flip side is, if this whole process of SEZs is cleared, then this could get a huge fillip. The DPU could get a huge fillip. And the third part is the global slowdown and impact on IT sector. So if we are, as India, we are moving up higher on the value chain by means of getting into the GCCs and all, then that would really mean that we are looking at a brighter future. So thank you so much. Do read the disclaimer, and you can always write to us on the support@reitspro.com. Thank you for watching this video.